Hello, once again. This is Steve Wolff, and we're ready for another episode of Steve's Stock Stories, which are becoming pretty popular these days, surprisingly. Anyway, today we're gonna deviate a little bit from what we normally do. Normally, we talk a little bit about stocks, hence Steve's Stock Stories, right? However, we're actually going to talk a little bit about bonds today, because I've got Greg Carroll with me, who's someone I've known for quite a number of years. We worked together. I think we started, what was it, Shearson Lehman or something?
Yes, something like that.
And you've been in the business since, what, 1994? And,
Yes, sir.
And I've been in the business since 1986. So we've seen a lot of things happen. So we're going to talk a little bit about what happened in the '08 time frame. Because everyone talks about how stocks are really risky and everything else, and people never really realize the risk that you can have in a bond. So before we get to the story, and before we get to you, Greg, I have to have a little disclaimer here. Otherwise, the lawyers will chop my you-know-whats off. So we don't want that to happen. And this whole Steve Stock Stories is just for informational purposes only. So don't just, it's not meant to for one specific person or what they have their portfolio. So if you've got something any questions about what we're saying, talk to your financial advisor or talk to your tax person or whoever it might be who you talk with before you buy anything that we're talking about. All right? So now that we got that out of the way, Greg Carroll, it's nice to see you.
Good to see you, Steve.
Yeah, I mean, we worked together at Shearson Lehman for I don't know how many years, and before you went off on your own?
Yes, I think about 7 years.
7 years, wow.
Yeah.
And then Greg came back to us, what, 2 years ago now?
2.5 years ago.
All right, so we've been working together for quite a number of years. At any rate, Greg, I know you and I talked about what happened in the '08, '09 timeframe, '07, when it looked like the banks were going to collapse. And talk a little bit about what happened to some of the bonds that or just tell us the story.
Okay, so the good thing here, as far as your disclaimer goes, you can't buy what we're going to talk about because it's no longer in existence. So what we're going to talk about is bonds that we purchased for our clients back in 2007 timeframe, and they were the Lehman Brothers bonds. And they were A-rated, high-quality bonds that you really wouldn't expect to ever lose any money with.
So A-rated, basically, for those who don't know, means what?
Well, you've got a bond rating scale, which starts at AAA rated. Government bonds would be considered AAA rated, all the way down to A, B, and even C and below is junk bonds. But so these are pretty high on the ladder there.
So they're pretty high quality.
Yeah, anything with an A plus,
Investment
AA
grade.
rate is high investment grade bonds.
Okay.
So you're just going to buy those, collect your coupon, your semi-annual interest payments until it matures, and you get your money back. But we ran into this thing called the Great Financial Crisis. And a lot of things happened in the financial services industry, one of which was the bond rating services, Moody's, Standard & Poor's. I can't remember if Duff & Phelps does bonds or if it's more real estate, but they're the ones that actually give these ratings to certain bonds. And apparently they weren't doing their homework well enough to actually understand what some of the bonds, what the real risk was in those bonds. And the way the financial services industry was evolving, they didn't understand how intertwined globally some of these banks and financial services companies were with different aspects all around the globe. So when there was a kind of a kink in the armor early that year in February, I think, when Bear Stearns ran into some trouble. Didn't raise a lot of red flags, but a few people started to notice. And then later that summer, what was the Treasury Secretary's name back then?
You're trying
Geithner? Anyway.
I don't know.
Very smart young
I think
fellow.
it was Geithner, actually.
It's something like that. And he was a very smart individual.
I can't remember what I had for breakfast this morning. You were asking me about 20 years ago or however long it was.
That was a long time ago. Anyway, he realized there was some serious issues with a lot of the big banks. And they had to call an emergency meeting with the Treasury, the heads of all the banks, J.P. Morgan, Bank of America, Merrill Lynch, all of them. But apparently Lehman Brothers was the one bank that may have been the most leveraged and the most in trouble during a financial black swan event. And
So, and by leverage,
well, it means that for every dollar of assets they took in, they were investing 40 times that.
I heard it was even higher than that. I
Yeah.
heard it was something like 80 times.
Yeah, it was astronomical. It should
Right.
never have been that high. And I don't know if it was public knowledge, how levered they were.
Right.
So they were kind of the sacrificial lamb at one point in September. And I remember talking to one of the large wirehouse firms that my partners and I worked at. I called them early, about a week out from them going bankrupt.
And when you're
Lehman
talking about
Brothers.
when you're talking about the wirehouse firms, you're talking about the well-known companies. I don't know specifically, but the Merrill Lynch's, the UBS's, the Morgan
Correct.
Stanley's, et cetera, et cetera.
Correct.
Okay.
Correct. So I started noticing the prices come down on these bonds. The bonds are priced at 100 is par value. That's what you buy them at when they're issued, and that's what they mature at. So based, on 100. Sometimes they go down to the, mid 90s maybe, up to 105 based on the interest rate environment. But these things were going down.
Well, the bonds really are priced much like a certificate of deposit is CD at a bank. You buy X amount of dollars worth, and let's say you buy $10,000 worth of a CD. You get your interest payments along the time frame that the CD lasts.
Right.
When it matures, you get your $10,000 back or whatever that amount is.
Right.
So supposedly it's similar to a bond.
It's
right? Isn't
very
that how it
similar.
works?
Very similar, yes.
Okay, so go ahead.
So I noticed these bonds the price was falling dramatically. I mean, they were like 70 cents on the dollar a week out from the actual bankruptcy. I didn't know how to call my clients and tell them I have an A-rated bond that seems to be in trouble, but we can maybe get 70 cents on the dollar. So I was calling for advice back to New York, the people that are supposed to be helping us kind of collaborate on these types of issues.
This is with the firm you're with.
This was with the firm. And they told me, no, Lehman Brothers is going to be okay. It's going to be okay. Said, all right, they get paid a lot of money to tell me, that kind of advice. Later in the week, though, the price was down to 60 cents on the dollar. I didn't know what to do, so I called New York again. And they told me the same thing, and I said, I am hearing that Lehman could go bankrupt. And with a bondholder, it works a little different than a stock where, there's a lot of different levels of bonds in every corporation. There's senior secured, senior unsecured, and then a bunch of subordinated debt. So depending where you're at on that hierarchy in a bankruptcy, you might get 10 cents on the dollar, 20 cents, 30 cents in a bankruptcy scenario. So these were senior unsecured debt, and I was saying I just didn't know that I want to hold on to these, and they talked me into holding on. And the news came out over the weekend that Lehman was going to go bankrupt. So on Monday morning, and that caused a major onslaught in the stock market. I mean, the ramifications were far and wide. I mean, it was.
And of course, all this was precipitated by what happened in the real estate market.
Yes, that was a big catalyst to it. Yes.
Yeah, I mean, this was that movie. I don't know what the name of the movie was.
Yeah.
Talked about how
The Big Short.
Yeah, it was at The Big Short where this one particular person at I don't remember what institution he was at, but he actually did some research into what was going on because everybody seemed to be getting a loan no matter how much you made. I mean,
Right.
A guy was making $30,000 a year and he was getting a $600,000 house, so he knew something had to be wrong. So when he went out to investigate all of that, he realized that these places they couldn't afford them.
Right.
Okay, and all these mortgages were underwater.
And a lot of those houses were just empty.
And they were empty.
Yeah.
Absolutely. So that caused all these people, especially the ones who were leveraged. And leverage, let's go back to stocks for just a minute. Leverage is the thing that really can kill you.
Yes.
In the 1929 stock market crash, it's exactly what happened. Individuals were buying 3 and 4 and 5 times, and maybe more, of what they actually had the cash to buy. And it was legal. Okay, well, when things went down, they had to come up with money because they were borrowing it, and they had to come up to pay off the debt. Well, to pay off 5 times what you had when you didn't have that to begin with, and everything's crashing around you, and that's what happens in stocks. Well, the same thing can happen in bonds, and that's exactly what was happening, right, in the
Right.
Lehman Brothers
Right.
situation.
Yes. So, I think the one thing that the financial crisis did do, it did kind of clean up the system a lot. The bond rating agencies are doing a much better job. The banks are in much stronger position. I think today. So when you buy an A-rated bond today, you can feel, again, you can feel very confident that that bond should come to maturity and get you all your money back. It would take, you should have a lot more confidence. But you got to know that, things can happen with a company, not necessarily with the market or the
Right.
Economy as a whole. But a company could have their own black swan event, which could cause it to be downgraded, and then you
Right.
do.
Any
lose some
company,
price.
any company can have an issue.
Anyone.
And if they do have an issue, then your bond, let's say they're going bankrupt, like you said,
Yeah.
and it can happen to any company.
Right.
And then your bonds are not going to be worth a whole lot. I mean, I don't think a Sears bond was worth a whole lot at the end. So
Right.
so that can happen. And I guess the point again is that it can happen in stocks or bonds. And so you have to really know what it is that you own.
Right.
There's a big difference between buying a company like, let's just say, Johnson and Johnson. By the way, you can buy that today, but don't buy it just on what we're saying. But there's a big difference between a Johnson and Johnson and XYZ Biotech Company.
Right. Yeah.
So, but back then, it's funny. I had a very similar experience to what you're talking about when I had the Lehman bonds. Fortunately, I didn't have it for a lot of people, but I had the Lehman bonds, and it looked like things were going bad. And of course, I called our bigwigs in New York, and they said, "Oh, no, everything's going to be just fine." Okay, well, I listened to them, unfortunately, unfortunately it was a learning experience for me and for my clients, but it was not easy to tell a client, "Hey, you've got a bond here that, you're pretty sure is going to be okay till maturity."
Right.
That's going broke.
Yeah, that's a tough conversation. It's not like with stocks that can move around a lot in price and always do, but bonds are supposed to be pretty steady on the statement. They don't move very much,
But they do move.
But they do move.
We're at a time frame right now. We've actually been in a bull market for bonds almost my whole career since 1986, and actually probably started during 82 or 83,
Right.
where the interest rates were extremely high and coming down. Well, why is that a bull market? Because as interest rates come down, prices on a bond goes up. And
Right.
we've talked about this before and some other things, so I'm not going to explain why, but that's what happens.
Yes.
Okay, now we're on the other side of that, where interest rates were almost at zero. And now it looks like, because of what's going on here with inflation, they're talking, the Fed is now talking about raising interest rates. Now you've got a little bit of a headwind for bonds. So those existing bonds could drop in price again.
Right.
But they should last to maturity where you're going to get your money back.
Yes, exactly. So it's not the same as the company going bankrupt, but yeah, you could see depressed prices for a while till they get close to maturity. And so you just want to be aware of that. I mean, if they're paying a good interest rate and you're comfortable with that, and the bond's highly rated and you're still going to get it at maturity or your value back, you can hold on to those.
Right. And it always comes down to know what you own.
Know what you own.
Know what you own, and if you do that, you'll probably be okay. Or, look, there's always something that can happen, all right? And there's not a person I know who's honest, who hasn't lost money in stocks for sure, and probably in a bond too if they've been in there long enough. It happens.
Yes.
You just got to make sure that you know what you own, and that's a good case for diversification.
Absolutely.
That you don't want to have, you wouldn't want to have everything you own in a Lehman Brothers bond at the time.
No.
Okay, and that's another thing too, and this is another topic that we'll get into with Greg at another Steve Stock Stories, but about concentration risk. Where you have everything in one company or one bond or one thing. That's where you can get really hurt.
Absolutely. Yeah. It's was it Peter Lynch said, "Buy what you know."
Right.
But you can buy too much of what you know sometimes. And if you're too concentrated, there's a big risk there to
right. Or if a person works for a particular company and it keeps getting more and more stock options and shares of stock, et cetera, and all of a sudden that person has 85% of their net worth wrapped up in one company. So those are things I don't want to get too much into that. We are going to talk about that again with Greg because he's got another good story, and that one's more on stocks than it is on bonds. So, So anything else you'd like to tell people about what your experience has shown as far as bonds are concerned?
I think what you said earlier. Know what you own, and if you ever have questions, talk to your financial advisor, your CPA, whoever your advisor is that you're entrusting to help guide you. You need to ask those questions. Don't be afraid to ask questions.
Right.
Because the more you know, the more you'll understand different movements in prices of bonds and stocks, and the more comfortable you'll be able to stay the course.
Right. I know I have some clients who always say, I know this is probably a stupid question. If you don't know the answer to the question, it's not stupid.
Absolutely.
Now, if you ask it 10 times, maybe that's stupid, but if
Steve never counts.
But if you really don't know the answer, ask us. We'll be more than happy to tell you.
Always happy to repeat it.
So anyway, appreciate it. This is another Steve Stock story. I'm Steve Wolff for Greg Carroll, and we really appreciate you just listening, and for those who are seeing this on video, watching us. We'll see you the next time. Thanks. Bye-bye.